Long before anyone considered Tesla stocks, CEO of ARK Invest Cathie Wood has always been a firm believer of the company and its prospects. Cathie Wood has always been bullish on Tesla stocks, but Cathie Wood has a massive warning today for other Tesla stock investors. Wood recently sold some of her Tesla stocks, and it amazed many people. But if you have been following her closely for a while, you would know that this is all part of her disruptive innovation strategy. Nevertheless, Wood has some pointers for Tesla investors, and they are significant hints as to what might happen to the company's stock in 2022. Why is Wood worried about Tesla's stock price? What are her warnings? Let's find out in our video today. With the events in 2021, many experts and analysts have predicted that 2022 will be a significant year for Tesla. The all-electric automotive and battery storage company announced a couple of noteworthy things last year. For example, the company announced that its Berlin and Austin gigafactories would be opened before the end of 2021. Due to some road bumps, Tesla could not keep their promises, especially in Berlin. The Brandenburg factory in Berlin was on course to open in 2021, but couldn't due to some difficulties with the government and fightback from environmentalists, among other things. In Austin, Texas, the Tesla factory is fully erected, and it seems to have begun welcoming new staff, but it has not been officially opened yet. Regardless, the new factories, which were not released in 2021, are expected to meet Musk's new prediction of an early 2022 opening. Once these factories open, they are expected to significantly increase the number of vehicles that Tesla produces, increasing their number and speed of deliveries. This is a significant milestone for Tesla as they look to increase vehicle production and broaden their global market reach. A Berlin factory would mean more sales and profit from Europe, much like what the Shanghai factory did for the company in China. The Austin factory, which has been touted as the Cybertruck factory, would allow the company to release their most anticipated vehicle ever, the Cybertruck. Tesla is a company dedicated to enabling the world to get greener. They have been creating vehicles that run on renewable energy since 2008 and have been building energy and energy storage solutions to aid their mission of a greener Earth rapidly. Aside from the factories, Tesla has a lot of other things in store for 2022. This has a lot of investors eager to invest in Tesla's stocks as they know that the company's stocks will go up in the coming months of 2022. The company's current stock price is down at $965, and many people are looking to invest as they know that a rise is not far away. But before you do, you might want to listen to what longtime Tesla bullish investor Cathie Wood has to say to Tesla investors. Wood released an article about Tesla stocks and her update on Tesla's stock prediction for 2025. So let's talk about Cathie Wood and what she thinks is the most considerable risk in the stock market and the economy as we approach 2022. Cathie believes that the biggest risk is deflation. Some stocks in the stock market are in a bubble. Their main focus is to satisfy investors by paying off dividends, so they're not investing money in innovation, which could affect them moving forward. The long-term case for good deflation is compelling. According to ARK's study, which is based on Wright's Law, 5 innovation platforms will unleash deflationary pressures that will accumulate over time and affect every sector, industry, and firm on a worldwide scale. According to Wright's Law, research reveals that the costs associated with every cumulative doubling in the number of entire human genomes sequenced using long-read technologies will be reduced by 28%. In comparison, those related to short reads will be reduced by 40%. Meanwhile, doubling the number of industrial robots and batteries produced reduces costs by 50% and 28% respectively. The cost of artificial intelligence training is falling at a pace of 60% each year. These platforms are converging, raising prospect of even more significant cost reductions as S-curves reinforce one another. According to current research, for example, believe it or not, a convergence of robotics, energy storage, and artificial intelligence will result in autonomous taxis with significant growth potential. By 2030, autonomous taxi networks could scale from no revenue today to $9 to $10 trillion globally, which, when combined with productivity gains from the time spent away from the wheel, could total more than $20 trillion. The cyclical case for deflation is a considerably more contentious issue. Supply chain bottlenecks that have lasted far longer than most of us expected have fueled debate, and the University of Michigan Consumer Sentiment Index has dropped to levels lower than those experienced during the coronavirus crisis. As stimulus payments inflated the savings rate to 33% in the spring of 2020, consumer spending on goods, which amounts to nearly 1/3 of overall consumption in the US, skyrocketed, obliterating companies that had closed. Before the coronavirus, companies were already in a risk-off mode, owing to trade concerns between the United States and China and a yield curve inversion in the late summer of 2019. As companies closed in early 2020, several households utilized government stimulus funds to hoard products, increasing the volume of inventory in their homes and garages. Consumers began holiday shopping early this year out of anxiety that shelves would be empty, driving the CPI inflation rate to 6.8% in November 2021, exacerbating specific supply chain difficulties. As a result, demand growth is expected to decelerate dramatically over the next 3 to 6 months, precisely as supply chain bottlenecks clear, possibly burdening firms with surplus inventory. If ARK Invest is accurate, the market will likely focus more on the possibility of a United States recession, a significant slowdown in the Chinese and emerging market economies, and a potentially unexpected decline in inflation during the next 3 to 6 months. Some commodity prices have already turned red. Iron prices have plummeted 36%, possibly due to China's real estate upheaval, while the Baltic Freight Dry Index has dropped 39%. DRAM prices have dropped 27%, and US timber prices have dropped 35%. Even the oil price, which has been a significant anomaly until lately, has dropped by 15%. Cathie Wood, who has been trading in the stock market since the 70s, said that in her time as an investment officer, she has noticed that when clients or investors see that a disruptive innovation strategy has fallen out of luck, even or in the very least maybe from negative headlines in the media, most clients end up selling their shares of a stock for meager prices, or as she put it, selling for near the bottoms of the market cycle. In this process, she believes that the client would turn what was supposed to be a temporary loss into a permanent one. This is why investment firms like Wood's ARK Invest focus on 5-year investment periods. In this time, they constantly update their clients to stop them from making any wrong decisions. Their primary message? Innovation solves issues and will improve people's lives rapidly during the next 5 to 10 years. ARK Invest takes advantage of volatility during declines and focuses their portfolios on the stocks they have the most conviction. Many broad-based market indices have risen to record highs since mid-February 2021, shifting away from growth companies and toward value and defensive equities, including the FANGs: Facebook, Apple, Amazon, Netflix, and Google. Fears that inflation may not be a short-term problem caused by supply chain constraints, but rather the product of overzealous monetary and fiscal policy reactions to the coronavirus and its derivatives are the main reasons for this shift. Inflation linked to solid economic cycles tend to boost value stocks, notably energy, financial services, industrials, and minerals. At the same time, increasing interest rates could harm long-term assets such as aggressive growth equities by boosting discount rates and decreasing the current value of future cash flows. Wood doesn't seem to be bothered about the current stock market trend, and although she has been selling Tesla shares, it still accounts for the majority of ARK Invest's owned stocks. Cathie Wood believes a considerable change is coming. She believes that the world order would change and conventional investment strategies would fail. Over the last few years, ARK Invest has been the buzz of Wall Street, beating the market and cementing its place among the leading players in the financial industry. Wood is the founder and CEO of this investment firm, and many have compared her to Warren Buffett's rising star. Many traders seek to mimic the moves of well-known investors and large brokerage firms to profit from the big dog's success. What do you think of Cathie Wood's warning to investors? Comment down below.